Hello, everyone. Welcome to another edition of Or More Than Market series. My name is Shalon Williams, and I am the Director of Investment Management Services at NEI Investments. So last week, I addressed what was behind the inflation numbers and the implications for investment portfolios. Today, I'll touch on another topic that's potentially adding to investors' worries, and that has to do with the geopolitical risk and the implications on economy and markets. So there are mounting concerns surrounding the tensions between Russia and Ukraine and what that could mean for markets. But before we get into market implications, it's important to provide some context as to what has been happening. So over the last few months, Russia has been building up troops on the Ukraine border. But until recently, it has been observed that there are now thousands more troops, which has caused many persons to think that Russia may be gearing up for a possible invasion of Ukraine. Moscow has denied that plans are being made to invade, but the fact that there are so many troops at the border can be seen as very threatening. In terms of the financial markets, geopolitical tensions have been on the radar of investors, and that has prompted the sell-off of risk assets. While we don't have a special or clear line of sight as to whether or not an invasion will happen or won't happen, we think it's still important to think about the possible implications and the economic consequences of that. While the human impact can absolutely be severe, when we think about the risk and what it means from a broader market perspective, it's important to look at what has happened historically. For example, when Russia invaded Crimea in 2014, that had an inconsequential impact on markets, but resulted in several sanctions on Russia. And when we think about 9/11, which was an unexpected event that markets did not see coming and was not able to price in, what happened during that time was that the US stock market closed for 4 days. The S&P 500 sold off double digits in the first few days following the attack. But within about a month and a half following that major attack on the world's largest economy, the S&P 500 was able to recoup all those losses, which was really a very short space of time to do so. And if we were to parallel that situation with Ukraine, the fact is that the market has had enough time to price in those risks relative to a 9/11 where that crisis really caught everyone off guard. So when we think about other implications, the invasion, those implications are more so skewed towards maybe sanctions being imposed on Russia. And in terms of the commodity space, Russia is a major commodity exporter or producer. So an economic risk is that trade could be disrupted and prices rise. And the EU is heavily reliant on imports of Russian energy. So a disruption in the supply could have negative implications on inflation within that region. So the economic risks are really region specific as opposed to be wide scale or as opposed to be very global in nature. So we definitely understand the concerns at this time. However, there are a few things to keep in mind. And one is markets are very resilient. And the historical data has proven that to be the case. And the points that I just alluded to in terms of what has happened historically, that has proven to be the case. And secondly, if these events are not expected to have a structural or permanent impact on economies or companies' earnings or valuations or fundamentals, then it's important that we stay the course with a long-term focus in mind. We at NEI Investments continue to monitor the tensions between Russia and Ukraine. However, from an asset allocation perspective, we still remain slightly overweight to risk assets and in particular to equities. So thank you for tuning in. Hope you found today's discussion helpful. Watch out for next next edition of our More Than Market series. And as always, reach out to your NEI representative with any questions that you may have. Thank you and stay safe. Bye for now.